ARGA's investment approach focuses on fundamental analysis. Our process centers around understanding long-term industry trends and completing our company analysis. And we don't focus very much on short-term market fluctuations. Our view is that while we incorporate different economic scenarios in our company analysis, we shy away from making specific macroeconomic forecasts because of the inherent difficulty in predicting them. Looking at the 12 developed market economies, it appears that a third of them have already started cutting rates, with more to do so the coming year. We believe that interest rates should move lower over time simply because policy interest rates today are lower than what long-term inflation trends require. But remember, central banks have as a priority low inflation, and they're probably not going to cut too much or too quickly.
Our investment approach is focused on investing in businesses with strong pricing power, repeatable revenues, and long duration of growth. Based on the discussions with our companies, we do see some slowdown in economic growth over the coming months. Chinese economy that long aided global growth has also slowed down due to secular and structural reasons. But Japan has just embarked on a rate hike cycle. So outside of Japan, we do expect some interest rate cuts in the US and other advanced economies. As bottom-up investors, we do not speculate on the count of cuts, but do expect the terminal rate to be higher than what it was when the rate hikes started.
It's hard to comment on the volume of rate cuts coming over the next year or so, but the direction of travel for the short end of the curve seems to be lower. For equities, most of the systemic valuation impact from the rate hikes is probably behind us, and we think the higher rate environment helped cleanse the system, forced businesses and consumers to reassess their priorities, cut out excesses in business models and investment fads, and separated contenders from pretenders. Recall that in the US at least, this was the fastest and steepest tightening cycle in the last 30 years. And with all that context, it seems appropriate for central banks to loosen up a bit.
Central banks look at the state of the economy and determine what interest rates should look like. Some of the variables they look at include the level of employment, how that's trending, how prices are likely to rise, and also how the overall economy itself is doing. So how central banks react to economic trends depends on the specific country you're looking at. Obviously, if inflation rates or prices coming down, unemployment is slowing down, as growth is slowing down as well, you're likely to see interest rate cuts.
The duration of the rate cut cycle will be data-driven and depend on economic as well as geopolitical factors. On the economic end, such decisions will be influenced by how the data on the labor market, inflation, housing, and consumer spending evolves. At the same time, external shocks from commodity supplies and fuel prices might also impact the inflation and economic growth outlook, and we cannot forecast that. That's why we don't speculate on the duration of the rate cuts. And as bottom-up investors, we address that by investing in businesses that are less interest rate dependent.
Over the next 12 months, determining how low rates go is rather tricky with the presidential election coming up in the US, Powell having to get the economy right, as well as his decisions risking being vilified by either party. So we don't really envy his job. When we think about owning businesses in portfolios at Sands Capital, the level of Fed funds rate matters much less to us than the company's ability to deliver earnings growth over the next 5 years. And our businesses have demonstrated their ability to deliver that growth even in a more constrained monetary environment.
Falling interest rates certainly boost economic activity and help make investing more attractive. Lower interest rates make investing in bonds or other fixed income instruments less attractive. That might shift investor money to equity markets as they're riskier and the costs of doing so are less. In addition to that, lower interest rates imply a lower discount rate in future cash flows of the company, making the valuation of that company more attractive.
While lower rates will help the valuations and the debt expense for the companies, some of this benefit will also be offset by lower expectations for profit growth. The expectations on growth were likely too optimistic to begin with and may now need to be reduced, given increasing signs of slowdown in employment, retail sales, and manufacturing. The markets have already reflected some of these expectations for the rate cuts. From here, the reaction will likely be driven by the count and magnitude compared to the consensus expectations, and we don't forecast that.
As business owners and consumers, we think clarity on the direction of rates, probably lower, will be a good thing. Uncertainty creates a lot of issues with businesses. How many people do I need to hire? How much inventory do we need to buy? How will we provide guidance? So clarity should help. While the market's interpretation of why we're cutting rates may dictate the magnitude, history suggests that the markets tend to rise following rate cuts, regardless of whether they're associated with a recession or not.
ARGA's portfolio, which is focused on companies which are undervalued relative to the long-term fundamentals, benefits in several ways. The first of which is that a lower discount rate is going to be applied if interest rates go down in a dividend discount model, which means that the valuation of stocks increases. Secondly, several of our businesses are in mature industries where they do use debt to grow or to even finance the existing business. As interest rates go down, the debt servicing costs come down, and that helps these companies either use that additional income to invest in new areas or even improve their existing businesses. Finally, several of our businesses are exposed to cyclical industries such as financials, industrials, and material companies, and if economic activity picks up as a result of lower interest rates, it boosts their earnings power as well. So overall, lower interest rates should have a positive impact on ARGA holdings through lower interest rate costs, improved valuations, or improved earnings from increased economic activity.
We do not position our portfolio for specific changes in the macroeconomic environment. Our companies have recurring revenues and predictable cash flow growth, and hence tend to perform better in periods of economic fluctuations. This doesn't mean our companies will be completely immune to such fluctuations, but does result in less variability. S&P Global, Novo Nordisk, Synopsys, United Health, and Visa are good examples of such businesses. All in, a moderating growth environment coupled with the rate cuts should generally be supportive of defensible and growth businesses, which are inherent to our philosophy.
We think a rate-cutting cycle should benefit growth equities. That said, we don't explicitly position our portfolio for short-term market catalysts, but take a business owner's approach to public equity investing and prefer to focus on long-term earnings power of businesses.